Hello everyone, welcome back to the Quantamental Investors YouTube channel. Talk of a financial asset bubble is growing rapidly. While AI stocks are getting most of the attention, beloved retailer Costco has a price tag that puts the AI bubble to shame. Let's break it down. So, Costco's stock has been on a tear lately, surging by 16% in just 3 months. But here's the kicker. This rally isn't driven by stellar business performance. Instead, it's all about trading multiple expansion. Over the last 3 months, Costco's forward price to earning ratio has ballooned from 46 times to a whopping 53 times. That's a 15.5% increase in valuation, accounting for nearly all of the stock's recent gains. But does the company's performance justify this lofty valuation? Let's dig deeper. Now, Costco did beat estimates in Q3 2024, but only by a small margin. Analyst revisions for future quarters are only slightly higher than before. So, the business fundamentals don't really explain this massive jump in valuation. Here's where it gets really interesting. Costco's current valuation implies that the market sees it as safer than US Treasury bonds. That's right. Costco has a negative equity risk premium, but last time I checked, Costco can't print money or tax the American public. This situation is quite frankly unsustainable in the long run. Let's talk growth. After a period of double-digit growth during the inflationary years of 2020 to 2022, Costco has settled back into mid to high single-digit growth. Analysts project 6 to 7% annual sales growth for the next 5 years. Our analysis is a bit more optimistic. We think Costco can achieve 6 to 9% annual growth based on their plans to open 25 to 30 new clubs per year and expected same-store sales growth of 3 to 5%. But here's the million-dollar question. Does this growth justify a forward price-to-earnings ratio of 53? For context, we're talking about a mature retailer growing at single-digit rates, yet it's priced like a high-flying tech stock. Using our valuation model, which factors in generous assumptions for future cash flows and growth, we estimate Costco's fair value at about $402 per share. With the stock trading around $850, that implies a potential downside of 53%. Even if we project forward 5 years and assume a generous price to free cash flow multiple of 25 times, we get a price target of $722. That translates to a negative 3.21% annual return over the next 5 years. In other words, at current prices, Costco stock looks worse than dead money. It's priced to underperform not just the broader market, but even risk-free treasury bonds. Look, Costco is a fantastic company with a rock-solid business model, but as investors, we can't ignore valuation. Right now, the market is pricing in hypergrowth for a mature retailer, and that's simply irrational. As the old German proverb goes, trees don't grow to the sky. Costco's valuation will likely mean revert at some point. For long-term investors, I rate Costco a tactical sell at these levels. That's all for today, folks. If you found this analysis helpful, don't forget to like and subscribe, and let us know in the comments, what do you think about Costco's current valuation? Until next time, happy investing.